Today I'm joined again by Peter from PJCO. Peter is my accountant, and the first question, I want to go straight into it, is for investors that keep coming to myself and to you, from what you've told me, a current question that we're getting is, should they purchase buy-to-let properties in individual companies? So per buy-to-let, should they have one limited company? I wanted to get your thoughts on that and why someone might do that, I guess.
Yeah, well, certainly, I think when you look on the internet, Justin, there are a number of companies that are suggesting the route for buy-to-let is to have one company with one property in it. That's not necessarily what we suggest, but that is a route. And I looked into why they might be suggesting that. And the real reason, as I see it, is that they might be talking about reducing down risk. So if you had, let's say you had one buy-to-let that you chose and it had particular risk around it, the area, the chances of other development. If that buy-to-let failed, so it wasn't worth what you paid for it, it's devalues or the mortgage is too expensive to cover it, if you've got one property in one company, if that buy-to-let failed, you give the property back to the mortgage company, and the debt would stick inside that one company. So you'd have restricted your risk to one property. If you had all of your properties in one company, then if that one failed, potentially the mortgage company could come and take their shortfall from your other properties. So you have restricted that risk. That's in theory.
Yeah.
In practice, you would probably have to give a personal guarantee as well as the company. So if that one failed and the mortgage company didn't get back all their money, they'd come to you.
Right.
Whether you put that in one company, one property in one company, or lots of properties in one company.
Yeah.
On top of that, if you had a record of not paying back mortgage companies, you're not going to be able to build your property portfolio very quickly because you're soon going to become a bad lender. So yes, in theory, one property in one company reduces your risk, but I think in practical terms, it probably doesn't. It obviously causes quite a lot of extra admin because if you've got one property in one company, you've got one bank account for that one property. Yeah. The next one, you've got another bank account and another property. You're soon going to have 10 companies, 10 bank accounts, all separate. It's going to be quite a big admin nightmare.
Yeah, I mean, from my perspective as someone that's been doing this 3 years, has a few buy-to-lets in a limited company, it seems crazy to run them all separately because of the amount of admin. I get that it reduces the risk, but if I had them in separate limited companies, I let one go or let one go, you're effectively letting it go bankrupt.
Yeah.
So the chances are you're going to have bad credit and not be able to get a mortgage for a long time in the future.
There could be a specific example. I think if you found a really risky investment and the rest of your portfolio was very safe, then you could say, well, that makes sense that I put that one in one company because a personal guarantee doesn't guarantee you'll have to pay back the money. Right. It's a promise rather than a guarantee. So there is a chance that if you had a really risky property, it might make sense to put that one in one company in certain circumstances, but probably not for the majority of buy-to-let.
Not doing it with all of them, for example. Okay, that's really interesting to get your thoughts. As I said, that's a common question for both of us. So, another one would be, I think there's a lot of talk about holding companies. You know, when would it be right for someone to open or set up a holding company for their limited companies?
Right. I think that the way we're looking at holding companies at the moment, the holding company will probably also be the property company as well. So you'll have a company at the top, which will be the holding company that will own property. And underneath it, it might own another company, maybe a trading company. So if, for example, I don't know, today you're running a plumbing business inside a limited company and you wanted to get into buy-to-let, there are two routes. One, you could have your trading company over here owned by you, and then you could go and form another company over here, a buy-to-let company, and the trading company could lend some money to the buy-to-let company. That would work, but the problem with that is there's a loan between the two companies, and sometime or other that's going to have to be repaid, or if it's not repaid, there's going to have to be personal taxes to write it off.
Okay.
So that loan is a bit of a problem.
Yep.
If you, instead of having two separate companies owned by the individual,
Yeah.
if you have the holding company owned by the individual and the holding company owning the trading company, the plumbing company,
Yes.
then you can get rid of those loans. The plumbing company can pay a dividend to the holding company, and
Yep.
that's not a loan, that's an expense. And the holding company can use that money to go off and buy to lets.
And do they pay tax on that?
No, there's no tax on that dividend going up. It also has a few other tax-saving routes through that. If the owner of the trading company, let's say this is a plumber,
Yeah.
if he sold that, potentially he wouldn't have to pay any tax on the sale of that trading company.
'Cause
So
the
there's
money's moving
other
up.
oddities of the tax rules that mean you can delay that tax. There's another useful, for some people, a useful benefit that if you've got a holding company with property in it, and underneath it you've got a trading company, potentially you might be able to get the whole lot outside of inheritance tax if you were unfortunate enough to die.
Right.
Potentially. This
Yeah.
isn't every case,
Yeah.
but sometimes that might work.
Okay.
And so there are a few extra advantages of having a holding company,
Yeah.
and a few extra advantages of that holding company owning property. I think we were talking earlier that you were saying that some mortgage companies don't like the fact that
Correct.
there's properties held in a company underneath the holding company.
Yeah.
This particular route solves that problem because the holding company owns the property.
Yeah,
Well.
that's really interesting to learn because I don't know how, but I came across that conversation with the mortgage broker, and I mentioned about the holding company structure, and they said there's less lenders or less products available if your buy-to-let company sits under a holding company. So I guess by making the buy-to-let company the holding company, you eradicate some of that issue.
Yeah, there may be
they're
some
at the top.
mortgage lenders that don't like that particular
Yeah.
route, but there's some quite significant advantages to certain people.
Yeah.
You probably need to have a trading business in the first place.
Yep.
There is a little bit of tax work if you do own a trading business at the moment and haven't got a buy-to-let holding company to get that trading business to be owned by the holding company. But that should be able to be agreed with HMRC in advance, that there's no tax liabilities.
Okay, fantastic. For someone, because this question just come up in my head, and I guess someone else might be thinking the same thing. I currently have two separate limited companies. I have a trading one, I have a property one. They're kind of sitting at the same level. Is that easy enough to make my property one the holding company?
Right. So what you're trying to do there is you own shares in the two companies.
Yes.
And effectively you're trying to sell your shares you've got in your trading company to your holding company. That's the transaction that's going on.
Okay.
Now, if you imagine that, HMRC think you've sold some shares for value to someone else, the holding company. So they might want tax on those shares.
Okay.
Yep. What we would do in the background,
Yeah.
if you wanted to do that transaction, we'd go to HMRC
Yeah.
and explain why this transaction is happening. It's not for avoiding any tax.
Yeah.
It's for rearranging your investments in a sensible way. You don't necessarily want these loans between the trading company and the buy-to-let company. So that's the reason you're doing the transaction.
Okay.
You can go to HMRC and seek clearance in advance. So
Okay.
we would go to them and say, Justin wants to move his trading company, so it's owned by his holding company. Do you agree that this doesn't attract a tax liability?
Fine.
And I would hope that HMRC will come back and say, yes, we agree it doesn't attract a tax liability.
Fine.
And then you can safely transfer the shares from one to the other and have that structure.
And the assets that were in the buy-to-let company that are moving to the holding company, do they just
No, those assets would already be inside a company.
Yeah.
So what you're really saying here is you've got your buy-to-let company over here
Yeah.
and your trading company over there,
Yeah.
and you're going to move your buy-to-let company so it
With the
becomes the
assets.
holding company.
Great.
So the assets aren't moving at all.
They're just going with it.
Yeah.
So okay.
It's only the ownership of the shares that's moving.
Yeah, no, that's great, and thanks for explaining that. So, to move on to a slightly different question, with everything that is going on in the economy right now, we've got an interesting couple of years ahead of us. Obviously, I'm giving advice to people I'm talking to from a very basic investor level as to how we can overcome and continue to invest with the rising interest rates. But is there anything you know, that you want to add to that? I know you have some views and advice to give kind of around, you know, trying to avoid being more of a hobby landlord and try to take it more of a profession, I guess, you make it more of a profession.
Yeah, I think lots of people have ended up in buy-to-let by default. You know, one way or another, they had a flat, they moved somewhere else, they rented it out, they haven't sold it, but they don't really treat it as if it's an investment. Right. Often those properties are worth hundreds of thousands of pounds. So you've got hundreds of thousands of pounds invested in buy-to-let, but you treat it as if it's a hobby. You're a hobby landlord. Yeah. You just wait for the rents to come, and you don't think about your mortgage rates. You just carry on. If you had that money anywhere else, a few £100,000 invested anywhere else, you know, say in your pension, it would be professionally managed by your pension company, so that you get a decent return on the investment. But you get lots of people. We're referring to them as hobby landlords. Yeah. They need to turn into professional landlords. You need to understand what return, what yield you're getting on your property in terms of rent. You need to understand what rate you're paying in terms of mortgage interest and how close that is to the rental yield. You need to understand those sorts of things. You need to understand when your mortgages are coming up for renewal and whether you should now switch to a fixed rate, a variable rate, you know, whether it's too late to make the change now. You need to really concentrate on your buy-to-let portfolio, so you treat it as if you're professionally managing it, rather than just let it go along and see what happens.
So take responsibility.
Take responsibility.
Learn what you're investing in and how it functions.
I mean, the margins are getting smaller, aren't they? With increase in interest rates, those margins in terms of yield are getting smaller, and obviously if they go negative, which you know they can, you're going to have to fund your buy-to-let portfolio, and that can be a bit painful.
Yeah, no, I agree, and I'm glad we touched on that, because I think it's super important for anyone brand new, or even anyone that's been in the investing game for a little while now, to treat it as a profession, understand what you're investing in, and have clear vision on the sort of investments, because now more than ever, as you said, those profit margins are small. So another one to do with, I guess, the changing economy and the current circumstances that we face. You know, a lot of buy-to-let landlords suffer from what is known as the landlord tax, or also known as Section 24. Do any of the recent changes have an effect on that? Any of the recent announcements and changes?
Yeah, the tax, on tax it doesn't. We've got to remember that the landlord's tax applies to people who own property personally or own property jointly. It doesn't apply if you own property inside a limited company. Yep. But the landlord's tax, Section 24, has quite a drastic effect on your tax rates. For a couple of years, I've been doing an example which says if you had £10,000 of rent and £8,000 of mortgage interest, you would make £2,000 of profit on that property. Now, if you're a higher rate taxpayer, so you earn above £50,000 a year, on that £2,000 of profit, you'll pay £2,400 in tax because of Section 24. Because Section 24 says you're going to pay at your highest rate on your rental income. So on that £10,000 of rental income, you're going to pay 40% tax, £4,000. Yeah. And on your mortgage interest, you're just going to get basic rate tax relief. So on the £8,000 of mortgage interest, you're going to get 20% tax relief, which is £1,600. Right. 4,000 minus 1,600 is £2,400 of tax on £2,000 of profit.
So you're £400 in the negative.
In the negative, on a property that's earning you a couple of £1,000s a year. Yeah. Now that example was a little bit extreme in the past, when buy-to-let mortgage rates were at 3% and yields were at 7%. Yes. But now it's probably going to become closer to the norm. As those mortgage rates go up, we could well see people with, as I say, 10,000 of rent and 8,000 of mortgage interest. And so there could be an awful lot more higher rate taxpayers that are paying more than 100% tax because of Section 24.
So off the back of that, are there any, I guess, recommendations? Would it just be to obviously go down the limited company route? Or?
Yeah, I mean, the limited company route isn't easy for those properties because it's not easy to switch them into a limited company. Yeah. I think it's important now that you look at your mortgage rates, you look at when it's renewing, you stretch the effects of increases in mortgage interest to see whether you could afford to fund that property in the short term or the long term. It's fine if you're earning lots of money and you could afford to throw a couple of £1,000 a month at a property that's losing you money after tax, making you money before tax, but losing you money after tax.
Yeah.
It's fine if you've got spare cash to do that. But if you haven't, then that's going to become a bit of a problem, isn't it?
Yeah.
And so you need to test what will happen if interest rates go up. Should I look at fixing them? Should I look at selling the properties? Should I look at how much it would cost to move them into a limited company so that tax rate becomes 19%, not 120%?
Fantastic. Okay, now I think that's brilliant advice, and we've covered a variation of questions there. I want to remind anyone that's watching that they can contact Peter using all of the contact information in the description below. I obviously work with PJCO and have had a fantastic time so far, so just want to recommend him to anyone thinking of getting into property investing or thinking of finding a new accountant. Peter, as always, thanks for coming on.
Thanks, Justin.
I'm sure I'll see you very soon.
You will.
Cheers.
Cheers.